2020 has been a very good year for equity returns, and that's despite all the atrocious news. So in this video, we're going to dig into the distinction between price and value and how to assess what the true value of an index or a stock should be. And if you do want to learn more about investing, remember you can always sign up for our free weekly market roundup. You'll see a link in the description below me and above me. So now let's look at intrinsic value in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Let's begin by looking at exactly what we mean by the word value. What you can see beside me is a list of price targets which are forecast for the S&P 500 for the end of 2020. And at the bottom of the image, which comes from Yahoo Finance, you can see these were forecasts made at the end of 2019. And remember, that's before we knew about the global severity of the pandemic. And I've plotted here the value of the S&P 500 from the beginning of 2019 through the March sell-off in 2020 and the subsequent recovery. And these red arrows that you can see are those forecasts. Notice how the price of the S&P 500 is higher than all of the forecasts. Now that's pretty remarkable, given that those forecasts were made assuming that everything was going to be just fine. Imagine you'd have gone back in time to tell those forecasters what was about to happen. Do you think they'd have increased their forecasts or decreased them? So that calls into question whether the price of the index that we can see today makes any sense at all. And that's why fundamental valuation is so important. It gives us a guide as to what the price should actually be. It doesn't mean that markets will agree with us, and many of the forecasts and models disagree with one another, but it does give you a fundamental idea of where value lies. The key thing to understand is that price and value are very different. Price is driven by market sentiment. People are driven to buy assets and sell assets due to emotion, but also due to narratives. This is what the tweet from Mohammed El Arian is effectively saying. People are simply making up narratives to fit the price action. At the beginning of the year, the narrative was that markets are not the economy. So even though we were seeing a global recession, it made perfect sense for equities to be rallying. Another narrative is that prices are justified by the huge amount of predictable central bank support which is out there. The fact is that people don't want boring models. They want a story, and it better be a good one. So the question is, can we do better than that? Can we move away from this narrative-driven justification of the price to something which gives us a much better handle on the value of an index? Let me introduce you, if you don't know him, to Aswath Damodaran. He's an expert on valuation, and he's been doing this for many years. He teaches at university in the US, and he's also written several books on valuation. But he makes a lot of this available via YouTube, but also on his website. And we're going to dig into some of his models later. And you can probably tell that I'm a massive fan. Here's a definition of intrinsic value which comes from Damodaran himself. The key thing is that we need a cash flow generating asset. So these methods will not work for something like Bitcoin or gold, which don't generate cash flows. But if we do have cash flows, the intrinsic value depends on two things. The first thing is the size of those future cash flows, not just for the near future, but for the entire lifetime of the asset. And the second important factor is the uncertainty of receiving those cash flows. If a company's on its last legs and it becomes bankrupt, well, you're not going to see those cash flows. So those two factors are the key inputs to these cash flow models. And later on in the video, we're going to see how Damodaran used one of those models to come up with an estimate for the value of the S&P 500. And as of the beginning of November, his estimate of the intrinsic value of the S&P 500 was 3,108. You can see that's well below the current value of the S&P 500, but also well below many of the forecasts that the brokers had come up with at the end of last year. If you're enjoying this video and you want to support us, you can now do that directly via YouTube by joining our YouTube community. There should be a join button underneath this video and a link in the description to do that. And if you do, you get a badge next to your name, which I have designed. It's great. The reason why some people say the S&P 500 is expensive is probably because of price to earnings multiples. So let's start off by looking at the forward price to earnings multiple. This is how that multiple has evolved over time. In order to come up with a price to earnings multiple, we look at broker forecasts for the 12 months ahead. This is a forecast of the profits generated by the S&P 500 over the next 12 months. And we take the price of the index today and divide by that forecast. And you can see in 2000, at the peak of the dot-com bubble, that reached about 23 times. People were willing to pay $23 for every dollar of profit generated by the S&P 500. Then the dot-com bubble burst and people weren't so bullish, so they weren't paying so much for those earnings. Then it reached a low point during the global financial crisis when people were only willing to pay about $8 for every dollar of profit. Since that low point, it's been rising steadily. And if we look at the latest values in 2020, it's around 21. So it's not far off those bubble valuations that we saw in 2000. It's well above its 5-year average, which is the dashed green line, and it's well above the 10-year average, which is the dashed blue line. So according to this measure, yeah, it looks like we're in a bubble. But the thing to remember is that that may be because the Fed has set interest rates to zero, as has almost every other central bank in the world. And that pushes people into riskier assets, and it pushes up the price of equity, as we'll see. Another measure people look at is the Buffett Indicator. This is simply the size of the equity market, its total market capitalization, divided by the size of the economy. And in this case, that's the US stock market and the US economy. What's kind of interesting is that it's generally trending up over time. So in the graph that follows from currentmarketvaluation.com, they've done something kind of nice, which is to subtract that trend. So this detrended data shows you when we're above and below the long-term trend. And again, what we can see is that the US equity market has far outstripped the size of the US economy. In fact, it's very close to the value it had during the dot-com bubble, just as we saw with the forward price to earnings. If we look at the growth of the US economy, and here I'm looking at nominal growth, so I haven't subtracted the rate of inflation, you can see that it's stepped down over time. It used to be around 8% up to about 1985. Then it fell to a trend of around 5.5% growth leading up to about 2007. But since the global financial crisis, even if I strip out the recessions, it seems to be growing at closer to 4%. Now, one criticism of the Buffett Indicator is that the US can sell to other economies, so it shouldn't see its earnings capped by US growth. But even if we do include something like global GDP growth, that has also slowed down over time. So now let's start thinking about intrinsic value and how we calculate it. As we've already seen, a key part of these models is the actual cash payouts that we get as investors. And those come in two forms. The first form of cash payout is a dividend, which you're paid as an equity investor. And that's at the discretion of the management of the company. They'll take some of their profits and they'll pay it back to their shareholders. Another way that the management can give money back to their shareholders is by buying their own shares. The reason why that's beneficial is that it reduces the number of shares in issue, and that concentrates your holding of the company. Effectively, you become an owner of a larger proportion of the company. And because there are less shareholders, you'll also get a larger proportion of the dividends. The other key input are the discount rates. And again, this comes in two flavors. The first one is the risk-free rate. That's the rate at which the government borrows because they have almost no credit risk. And the second part is the equity risk premium, which is the extra return that investors demand for buying equity as an asset class. And if we combine those, we get our discounted cash flow model, the output of which is our intrinsic value. Before we look at the full discounted cash flow model, it's useful to build up your intuition using a toy model. This has all the same moving parts, but it's a lot simpler. Our first job is to come up with the projected cash flows that we're going to receive by owning an asset. Of course, we don't know what those are going to be. All we can really do is take a stab based on historical cash flow growth rates. So I've chosen a value for the S&P 500 of about $155. And what I'm going to assume is that that's going to grow at a rate of 2.55%. So that in 1 year's time, we'll see that grow to $159. And in all subsequent years, it's going to grow at the same rate of 2.55%. To turn those future cash flows into a value today, we have to discount those cash flows. Now, the discount rate at which we do that is a sum of two things: our risk-free rate, which I'll take to be 2%, and the equity risk premium, or ERP, which I'll take as a long-term average for the S&P at 4.82%. Add those up and you get 6.82%, and that's going to be our discount rate. So I take that $155 and I divide it by 1 plus the rate, and that gives me $145. So the value of $155 to me today is $145. Then the payment in 2022, which is $159, is now worth $139 as of today. And we calculate that by taking the $159 and dividing it by 1 plus the discount rate squared. And the number 2 comes from the fact that it's 2 years in the future. And we repeat that discounting for all of the future cash flows. In this case, we've shown just 5 of them. But notice how as we go further out into time, we're cubing this number on the bottom, then we're taking the 4th power, then the 5th power, and that reduces the size of the future cash flow, because money given to me in 2025 is worth much less than money given to me in 2021. And then to work out the intrinsic value to me today of those 5 future cash flows, we just add their discounted values. And you can see that the summed value is $670. But remember that Damodaran said we look over the entire lifetime of the asset. So we actually have to go much further out in time. If we extend the analysis 10 years into the future up to 2030, and then we add up these discounted cash flows, we get a sum of just over $1,200. But notice that these still haven't converged to a very small value. So we're going to have to go even further out in time. In fact, we have to go out far enough so that these discounted cash flows fall to almost zero. These are the discounted cash flows looking out over an entire century. And you can see that the cash flows are now getting pretty close to zero, although we're not quite there yet. But if we add up those discounted cash flows, we're getting to a value which is pretty close to the S&P 500 at the moment, which is 35.68. If we take it another century into the future, we get 36.28. Another century would give us 36.29, and then you can see we've pretty much converged. Because if we add another century, the value's the same. So making those really simple assumptions about the growth rate of future cash flows, but also the equity risk premium and the risk-free rate, we can come up with an estimate of the intrinsic value of the S&P 500. Now, you don't have to do this crazy exercise of taking thousands of cash flows into the future. There's a very simple equation which does exactly the same thing, and this is the only equation which we're going to discuss, so don't panic. So here's the equation. It's very simple. It's simply got the first cash payout, the risk-free rate, the equity risk premium added up here to give us our 6.82%, and our growth rate here and here. So the intrinsic value of the index is just our first cash payout, grown at the payout growth rate for 1 year, which means we can simplify our equation so that we simply have the second cash payout on the top and these 3 numbers on the bottom. ERP, remember, is the equity risk premium. And the point of this equation is that it gives us our intuition about how intrinsic value is affected by these factors. So let's look at what would make the intrinsic value increase. Well, firstly, if the risk-free rate decreases, then we're dividing by a smaller number, which means the intrinsic value will increase. And the same is true of equity risk premium. If that falls, the intrinsic value rises. And if the growth rate of our future cash payouts is higher, obviously that's a benefit to us and it increases the intrinsic value as well. So however complicated the model you're about to see gets, remember those 3 things. And as we said at the beginning, one of the reasons why equity prices are so high is that we've seen the risk-free rates falling fairly steadily since the early 80s. And as the risk-free rate falls, that's the rate on treasuries, the intrinsic value will rise. And the pattern for equity risk premium, which is the additional return that investors demand in order to buy equity above that of the risk-free rate, that's moved around quite a bit. So for example, in 2000, when equity prices were very high relative to fundamentals, equity risk premium was at a low. But over the last decade or so, you can see ERP has been bouncing between about 5 and 6%, according to Damodaran's own estimates. So that was the prelude that built up our intuition. Now let's actually look at Damodaran's model. If I'd shown this tweet at the beginning of the video, you probably would have freaked out. But hopefully now at least some of this stuff is going to be more familiar to you. This box at the top of the page is just looking at which types of equity performed well since February the 14th. And it is really interesting because you can see that expensive stocks did well, both on price to earnings, but also price to book value. Also companies with no or low dividends. This rally's favored young companies with high growth, also small companies with very little debt. But the model itself is in the bottom part of this page, and that's what we're going to focus on. So the first step, as we saw, is to project future cash payouts for the asset that we're going to buy, in this case the S&P 500. And the assumption that Damodaran's making is that earnings are going to drop to 130 in 2020. Then they gradually recover to the kind of trend that they've had over the last decade or so. But remember that we don't actually get paid those earnings. We just get paid some proportion of them as investors because we get paid dividends and we also get paid in the form of share buybacks. So what Damodaran has assumed is that we extend the current level of dividends, but we drop the percentage payout by about 20%. So companies are hoarding some of their cash in order to preserve cash on their balance sheets to survive this revenue fall. And they're also being less generous by buying back less of their shares. So he's assuming that share buybacks will fall by about 50% in 2020. So if we compare the pre-corona and post-corona earnings, you can see that there are fairly steep falls in the first year, but then that impact very rapidly reduces to about 5%. But Damodaran does factor in a little bit of scarring here because it never actually gets back to its pre-corona levels. Now, are these a perfect reflection of what's going to happen to earnings? Of course they're not. They're just a guess. But that's the value of a model. You can take your estimates of what's going to happen to cash flows, but also risk-free rates and equity risk premium, and use a structured approach to turn it into an intrinsic value. Let's look at those cash flows in graphical form. So the blue bars that you can see here are the historic S&P annual earnings. This is the fall that we saw during the global financial crisis in 2009, after which earnings bounced back very quickly. Then there was a bit of a stagnation and we saw Trump's corporate tax cuts, and that boosted earnings, and now we're seeing a fall due to coronavirus. But notice how by 2021, Damodaran expects things are pretty much recovered. So these red cash flows correspond to this column here. So the first one is 130.21, the second one is 166.21. So here you can see the heart of Damodaran's model. So this is where you actually sum those discounted cash flows that we saw earlier. And in this diagram, he goes through all of the inputs and where they come from. So he starts off by saying what the S&P 500 companies generated in terms of earnings in 2019 before the crisis hit. They paid out $163 and gave $146 of that back to shareholders, primarily through buybacks. So that made up about $88, but also through dividends, which made up about $59. Then he goes into a bit of detail on how earnings are going to drop to 130 in 2020, as we saw, but then recover very quickly to 166 in 2021. And he's made part of that drop temporary or transitory, as he says, but due to the scarring effect, 20% of that drop is going to be permanent. And he says how much dividends are going to fall, and also buybacks. So the impact on our cash flows is effectively going to be over by 2024, according to his estimates. Now the risk-free rate is kind of interesting because Damodaran uses the 10-year Treasury yield as that risk-free rate, which on November the 1st was 0.88%, a very low rate. And also interesting is the equity risk premium, for which he's used the average over this very strong equity rally over the previous decade, and that's 5.58%. So our discount rate will be the sum of these two. It'll be the equity risk premium, 5.58, plus the risk-free rate, which is 0.88. So this number here, 6.46%, which he's using for discounting, is a sum of those two numbers. So looking at year one, which is here beneath me, you can see that the expected earnings are 130.21. 75% of that is given back to shareholders in the form of dividends and buybacks. And $750 of $130 is $97.86. We then discount that using the rate of 6.46%, and we arrive at a present value of $91.73. Then we repeat the exercise for the cash flow for the next year in 2022, and the present value there is $114.63. And then beyond year 5, we use that equation that we saw earlier to sum up all of those infinite tiny cash flows. And then when we add up all those numbers, hooray, we come up with the intrinsic value, which is 3108. It's probably worth saying that after year 5, the risk-free rate changes. So it rises to 2%, which is more in line with historical norms. And the equity risk premium drops to the long-term average, which is 4.82% for the S&P 500. Now, the trouble with just coming up with a single value for the S&P 500 is that it doesn't account for uncertainty. Are we 100% sure that the S&P's intrinsic value is 3108? Well, of course not. So what we do is we factor in our uncertainty about the inputs by doing something called Monte Carlo simulation. So for example, the equity risk premium doesn't have a fixed value during the Monte Carlo simulations. He plugs in multiple values of the equity risk premium, peaked at around 5.58%, but fluctuating around 15% around that most likely value. And similarly, for each of the inputs, he looks at the plausible distribution of what it could be and simulates multiple values of the S&P 500 based on those alternatives. So what he ends up with is a distribution of the intrinsic value of the S&P 500 using all the plausible values of the inputs. So the most likely value of the estimate is 3100, but there's a huge amount of uncertainty. Could it have a value above 3200? Yeah, that's actually quite likely. Could it have a value below 2900? Yeah, that's quite likely too. But would it have an intrinsic value above 3800? Almost certainly not. So with any model, it's really useful to have a handle on how sensitive it is to the values of the inputs, but also to see what plausible values could come out of the model if you slightly adjust the inputs. So I think it's a great idea to try multiple models and maybe even multiple approaches to get a handle on value. I think you're much more likely to get a good picture of what's going on if you do that. And if you enjoyed that and you want to learn more, what better way could there be than to join our community online? It's very easy. You just click on the icon that's beside me and that'll tell you about how to get access to all the goodies, including a growing library of members-only content and the chat application Slack, where you can talk to me and other members of the community. And, as always, thank you for listening.